Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing well. How about yourself?
Good, thank you. Today we're going to talk about taxes. Okay, we're far enough into 2018 that we can talk about the new laws that are put in place. The tax reform law is set. Do understand that it's not going to affect your 2017 taxes. It's going to be your 2018 taxes. So you have this full year to understand how the taxes are really going to fall in place for you. But we're going to discuss that a little bit. First and foremost, though, understand that Tyler and I are investment advisors. We are not CPAs. Okay, we don't prepare your taxes. We have people on staff that do prepare your taxes, and they'll consult on which accounts to withdraw from first. But understand taxes is a major part of the retirement process. Done incorrectly, you can have things such as your Social Security becoming 50% taxable, 85% taxable, and so on. So it all depends on where you pull your money from to determine how taxes is going to hit you in retirement. So today we're going to talk about some of the new reform bill that's going to go in place. And really, there's certain reasons for having it done. And the U.S. Congress Committee on Ways and Means explains it with a number of items. Tyler, let's talk about some of those items that they have for the tax law and the purposes for them.
Yeah, Dean, with the new tax reform bill for 2018 moving forward, it does have stated purposes for the reason behind the bill. Just going to run through a number of these before we really dive into things here. But number one is simplifying the tax process. Now, who knows if that's yet to be seen. We won't know that until we file our taxes for 2018 and early 2019 and thereafter. But simplifying the tax process. The other one is preserving the mortgage interest deduction. So that was another one that in 2017 and before that deduction was available. It is still made available, not as much as it was before, but that was one thing they wanted to preserve. The other being eliminating Obamacare's individual mandate penalty tax. So that's where if people who don't have health insurance, they're penalized, have to pay a penalty currently, and they will have to in 2018, but then starting in 2019, they will no longer have to pay a penalty if they don't have health insurance, a tax penalty, that is. The other one is increasing the standard deduction. We'll get into that a little bit later, but the standard deduction you can take almost doubles, providing more support to American families, providing relief for Americans with expensive medical bills, and improving savings vehicles for education. So that deals with 529 and college savings plans, and that's another thing that we're also going to touch on quite a bit a little later on in the show. But those are some of the things that the new tax reform bill has in terms of the explicit purposes that it wants to accomplish.
Okay, so when you talk about simplifying the tax process, I think that's important, very important. I do want to find out, though, how big that index card is going to be that we're going to be able to do our taxes on in 2018. Okay, so one of the main things is early on when it was proposed, this tax reform, there were two different sides looking at how many tax brackets there would be, Congress versus legislation. They were talking about, how many brackets and what's going to be the threshold in the brackets. Tyler, now that it is law, what are the brackets? Are there as many, and what are the financial thresholds in the brackets?
Yeah, Dean, good question there. And before I jump into the brackets and the number of brackets and the tax rates, I first just want to say that in the United States we have a marginal tax rate, meaning, and I'm just going to throw out a rough number out there just so people can understand, but let's say if you made $100,000 in income and you're in the 25% tax bracket, that doesn't mean that all $100,000 is taxed at 25%. It simply means that your first maybe $20,000 is taxed at 10%, your next $50,000 is taxed at 15%, and then anything thereafter is taxed at 25%. So it's gradually increasing based on your income is your tax rates. And with that said, in 2017 and before, we had 7 different tax brackets, and those are the 10%, or 7 different tax brackets, 7 different tax rates. Those are 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. Now, we still have 7 brackets in 2018 and moving forward, and those are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So a few of those numbers did change, most notably for the lower and middle income tax brackets. So 10% stays the same. There still is going to be a 10% bracket. That's the lowest one. Then previously in 2017, there was a 15% bracket. Now there's a 12% bracket. So a lot of people, a lot of our clients that we see who are in the 15% bracket now are going to be dropping down to the 12% bracket. Then the other one in 2017, it went from 15% up to 25%. Now in 2018 and forward, that 25% drops down to 22% or 24%, depending on your income. So either way, that gives a lot of Americans a tax break depending on what your income is in there, and that all also depends on your tax bracket. But I just want to have a quick example here where if we have a married couple with taxable income of $75,000 in 2017, so that's middle class around here. You're married, your husband and wife, and they make combined income of $75,000. Well, in 2017, they paid roughly $10,300 in taxes. Now, in 2018, that same couple with $75,000 in income would have paid about $8,600 in taxes. So it's about a $1,700 difference. Now, $1,700, that may not seem like a lot, but keep in mind, if that same couple made $100,000, it'd be about a $2,700 difference. They would have saved $2,700 in taxes. So either way, if you look at it, $1,700, $2,700, whatever that number is, you're saving a little bit each and every year. And it may seem like a little bit, but over the years, that can really add up, and you can use that money to pay off debt, maybe use it to contribute to a retirement account, use it to gift to your kids or give to grandkids for a 529 college savings plan. So you can use that for a number of different things. And obviously, myself and Dean as financial advisors, that's what we recommend is to use it for, whether it be debt payoff, retirement accounts, whatever it may be. But over time, even a little bit of a tax break like that where you get an extra couple $1,000s in your pocket, it can go to many different things. Okay,
good points, Tyler. And the other thing, too, is it can get quite confusing when you start throwing around numbers and different brackets. If you go to the internet, check out irs.gov. That's the official website of the IRS. They have the brackets there, and it shows them in comparison to each other. Very easy to follow. So just go to irs.gov, and you can look at the different tax brackets from 2017 and 2018 going forward. Okay, another difference here that we're looking at going forward is a difference in the standard deduction. Now, before Tyler really explains it, in detail, just broadly, you've got a standard deduction or an itemized deduction. To differentiate between the two, an itemized deduction is somebody who has a number of line item expenses that your tax preparer or CPA puts into your taxes to bring down your income. A standard deduction is typically used for those people who don't have enough itemized deductions, so the standard deduction actually gives you more of a break when it comes to your taxes. It brings down your income even more, which is helpful when it comes to taxes. But you heard early on with the new tax reform that the standard deduction was going to double. How does that affect things, Tyler? Standard deduction and the difference now?
Yeah, so good points there, Dean. With the 2018 tax reform bill, the standard deduction has almost doubled. And really, like you said, the standard deduction is an automatic reduction in a taxpayer's tax obligation. So it's a direct deduction against their income. It lowers their taxable income. Now, with 2018, the tax reform and moving forward, I assume many people will not be itemizing when they had previously simply because of their standard deduction. So really, in 2017, if you were single, the standard deduction that you could take was $6,350. Now, if you're single in 2018, that bumps up from $6,350 to $12,000. So it almost doubled. If you're married filing jointly in 2017, that number was $12,700, and in 2018, that jumped up to $24,000. So again, those almost doubled. Standard deduction, that almost doubled, and again, that makes itemizing look even less worthwhile. However, the 2018 tax reform bill, it also eliminated the personal exemption. So that's the other hot topic, where the deduction had just about doubled, but then the personal exemption, which is the amount a taxpayer gets to deduct from their taxable income for themselves and any other dependents that they may have on their tax return, that was eliminated. So really, here's how those two changes play out. In 2017, that personal exemption was $4,050 per person and dependent. So in 2017, if you had a married couple who was filing jointly with no dependents, so their personal exemption would be $8,100. That's $4,050 times 2 for both the spouses, $8,100. And they also received a $13,000 standard deduction, and this is based on if they had $100,000 in income. So they make $100,000, receive that $13,000 standard deduction, and $8,100 in personal exemptions, leaving them with a taxable income of $78,900. So almost the taxable income at that point would be almost $79,000. Now in 2018, that same couple will simply receive that $24,000 standard deduction and no personal exemptions, leaving them with taxable income of about $76,000. So really, in that case, it's about $3,000 less in taxable income that they have to record for tax purposes. So really, the main purpose with the standard deduction and personal exemptions is that the tax reform bill simply simplified this portion of the income tax process, just forgetting about the personal exemptions, making it one standard deduction and going from there.
Okay, you bring up a good point, because I know early on we had a lot of people wondering, if they take away the personal exemption but double the standard deduction, are they just playing the shell game? We're just robbing Peter to pay Paul. Actually, when it's laid out this way and you look at scenarios, the 2018 scenario would be beneficial for most people, correctly, because it brings down their income.
Yep.
Okay, now something else, some other changes. We've got a difference in child tax credit. That's very important for those people who do have children, have dependents. How does this play out in 2018, Tyler, versus 17?
Yeah, Dean, this is another one here, the child tax credit. So really, in the current tax code, if parents make less than $110,000 jointly, so if you're married filing jointly, or $75,000 individually, they currently receive a $1,000 child tax credit for qualified children under the age of 17. Now, in 2018, that tax reform bill increases the credit to $2,000 per qualified child and raises the income limits for the credit to $400,000 jointly and $200,000 individually. So really, the income limits are a lot more in 2018, meaning you can make a lot more and still take a child tax credit. And then it also doubles the amount that you receive for that credit. So instead of $1,000, it's $2,000 and per child. So really, that means a lot of people will be able to receive tax credits for their children. So in this case, maybe the kids are finally paying off.
Yeah, that's good. So in summary, really what it does do is it gives you more of a tax credit monetarily for each child, and it also applies for more people as the income limit went up, correct?
Correct, exactly. Yep, you can make more and also take that credit, but then that credit also doubles.
Okay. We're going to talk a little bit more about, more changes for the taxpayers with kids. We're going to be talking about 529 plans, which are extremely important for those people trying to help somebody fund their college education. But before we do that, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back. We're going to talk about 529 college savings plans. Tyler, was that affected with the new tax reform law?
Yep, it actually was 529 college savings plans. This is a big one here, and I know myself and Dean, we're big proponents of 529 plans. If you have a child or grandchild and you know that they're going to be going to college, and right now, a 529 college savings plan, it acts like a Roth IRA for a college education. So it's money, a 529 college savings plan is money that you contribute, that you put in, whether it be through savings or checking. So it's after tax dollars, money that was already taxed on, and you open a 529 college savings plan, and then that money then grows, and you don't pay any taxes while it's growing. It's tax deferred. And then if it's used for college expenses, it's tax free. So that's how it works, kind of like a Roth, where as long as you use it for college education right now, it's tax free, which is definitely a huge benefit. You can't get that in a lot of other accounts, really any other accounts besides a Roth, which is used for retirement. But again, you do have to use it for different college education expenses like room and board, tuition, food, anything like laptops, books. So a number of different college expenses is what it's limited to. Now, the new tax reform bill changes this significantly because right now it's called a 529 college savings plan, meaning you can use it for college. Now, you can use it whether it's a 4-year school, a 2-year school, a graduate school. It's very flexible in terms of what you can use it for after high school, but it's limited where you can only use it for, after high school, whether it be any type of college, vocational school, whatever that may be, even apprenticeships. However, now, starting in 2018, if you have that 529 savings plan for your child, you can use it for levels of education other than college. So, for example, if you have children in private school, which is a big one that comes up, I know I've met with quite a few clients who wanted their children to go to a private elementary school, middle school, even high school, and a lot of those are pretty costly. Some of them cost upwards of $5,000 per year for some of the private schools. They wanted to know if they could have any type of college savings plan. Well, really in the past you couldn't because it was only for college. They couldn't use it for elementary school, middle school, high school, anything like that. But now you can. So like I said, if you have children in private school or if you have to pay for tutoring for your child in kindergarten through 12th grade, you can use money from your 529 for these expenses tax-free, which really, really helps where you can use it earlier or later. So again, 529 college savings plans, now they're not only a good option for college, but also for elementary school, middle school, high school as well. So just it really diversifies it even more so, the uses for it.
Okay, so that's good going forward. It's good for the people who are funding the 529. It's also good for the recipient of the 529 that it's not just for college. It can be used for other type of schooling too. I think that's a great move. Difference for homeowners. Now, this one is interesting because I do know in 2017, a lot of people were getting calls from their CPAs and so on. They were asking about, is there anything I can do this year that is going to help me from a tax standpoint? So what is really going to happen, Tyler, going forward, the difference for homeowners and how the new tax plan is going to help them?
Yeah, with homeowners and the new tax reform bill of 2018 does change a little bit in terms of the mortgage deductions. Now, currently, if you itemize your deductions, the IRS, they allow homeowners to deduct the interest they pay on their primary residence or their second home up to a maximum of $1 million in your original mortgage principal. So the maximum right now you can deduct is up to $1 million. Now, this can include more than one loan as long as the total is below the $1 million limit. And it can also include loans to refinance your home as well as mortgages to purchase a home. So with that said, up to $1 million, now the new maximum tax reform bill is $750,000 in original mortgage principal. So this one, it does decrease the mortgage, what you can deduct from that a little bit, from up to $1 million down to $750,000. However, taxpayers with existing mortgages in between $1 million and $750,000, they will be grandfathered into the old deduction. One other item to note here is that taxpayers are also currently allowed to deduct interest paid on home equity debt up to $100,000, and the tax reform bill has removed that deduction. So what you can deduct on home equity debt. But really here with the homeowners and the mortgage deduction here, in the past you could deduct up to $1 million. Now it simply is down to $750,000. So you do get a deduction, just not as much as you had previously. But with that said, Dean, I want to quick jump and talk about the estate tax exemption. So this right here is, I get a lot of questions from clients, but really the estate tax, it's a tax on inherited money and property, because we get questions from clients where they might inherit money from a mother that had passed, a father, a grandparent, and the number one question is always going to be, I inherited money, do I have to pay taxes on it?
That's right.
Well, with that said, keep in mind the short answer is no. However, in some cases it can depend. So if you inherit money or property, there's no inheritance tax in Wisconsin on estates under certain limits, and inheritances, those are one of the few things that the IRS is lenient on, meaning you typically don't have to pay any taxes. Currently, people pay a tax rate of 40% on any inherited property valued at over $5.49 million. Now, that is the estate tax exemption, meaning if you inherit property over $5.5 million, then you're going to have to start paying taxes on that. Now, a ton of people won't have to worry about this. 99.99% of people aren't going to have to worry about inheriting property over $5.5 million. Many of us wish we did have that problem, but unfortunately we don't. In the new tax reform bill, individuals have an $11.2 million lifetime inheritance tax exemption, and married couples can exclude inheritances of $22.4 million. So really, with the estate tax, people now who are inheriting, if you're an individual up to $11.2 million, you don't have to pay any inheritance or estate taxes on. And if you're married and you inherit an estate of up to $22.4 million, you won't be taxed on that. So as you can probably imagine, this won't leave too many families paying the estate tax. But one other thing that I wanted to add on here, and this doesn't really go along with the estate tax, but with inheritance taxes, is I just got a question from a client where they inherited a stock. Their father had passed and they inherited stock, and they wanted to know if that was taxable, if they had to pay any taxes. Well, the one thing with stocks is that you get what's called a stepped-up cost basis, meaning on the date of death, that's now your new basis, and then anything above that is taxable. So you can sell that right away and not have to pay any taxes. So again, inheritance taxes and things of that nature, that's something that the IRS is pretty lenient on.
Okay, that's good to know, because it's always hard to stomach that you have to pay significant taxes on something you inherit. It's usually, a nice situation that you do inherit, but it's not something that you're in control of. Okay, what about charitable donations? Each year when people come in with their taxes to meet with our tax preparer and tax advisors, they come in with a bunch of receipts for their charitable donations. I tell people, when in doubt, bring the receipt in, okay? Yeah. Bring it in. And we'll have certain clients say, well, I've only got a couple $100, but they don't realize that what was happening is if you're itemizing, those go along with other receipts and other expenses to work in your favor. Now going forward, Tyler, in 2018, what is going to happen with the charitable donations and the change we're going to see?
Yeah, good question there, Dean. Charitable donations, that's another big thing. A lot of people do donate to different causes, different charities, and they want to know how that affects them tax-wise. Now, under the current law, so under 2017 and before, you could deduct up to half of your income in qualified charitable expenses if you itemize your deductions. So again, you could deduct up to half your income in those qualified charitable donations, which that obviously makes it a popular deduction for people at all income levels when you can deduct up to half your income for those. However, the new tax reform bill has increased that limit from half or 50% all the way up to 60% of your income. So again, that's a really great incentive to get taxpayers to donate to charities. I know we have some clients that they take a withdrawal from their IRA and they have it directly paid to a charity. They also have different beneficiaries who are listed on their accounts as charities, and they make donations to them each and every single year. So again, that's another really big deduction, especially if you itemize your deductions. But charitable donations is a huge one. However, there's one donation that will no longer be deductible, and that's donations made to a college in exchange for the right to purchase athletic tickets, which that was in the past. You could deduct those where you made a donation to a college. Maybe it was your alma mater, Wisconsin, UW, Green Bay, whatever it may be, and then you got, in exchange for that, you got athletic tickets, which seems like if you want to donate and you're a sports fan, it seems like a pretty cool thing, but you can't deduct that anymore. So that's one thing that you will not be allowed to deduct.
Okay. And now let's talk about one of the hotter topics when it comes to the new tax reform law, and that is Obamacare and repealing the individual mandate. Now, people have to understand the individual mandate was a fine. It was really imposing taxes on you if you didn't have health insurance through the Affordable Care Act or Obamacare. So what happened here with the tax reform law, that fine or that taxes that was imposed on you is now gone. Okay, Tyler, how does this affect people, though, going forward?
Yeah, so like you said, Dean, with the Affordable Care Act or Obamacare, that's in effect for 2017. Now, the new tax reform bill, it does repeal that individual mandate, meaning people who don't buy health insurance, they'll no longer have to pay a tax penalty, where in the past 2017 and before then, if you didn't purchase health insurance, you're penalized in the form of taxes. You have to pay a tax penalty. Now, starting in 2019, so for 2018, that Obamacare penalty can still be assessed. So that's the one thing in the new tax reform bill that can still happen in 2018. But starting in 2019, that change then goes into effect where if you don't have health insurance, you won't have to worry about paying that health insurance penalty any longer. And again, health insurance in general and Obamacare is something that will be a hot topic moving into 2018, 2019, just because it hasn't been changed yet. Who knows if it's going to be, but again, it's just a hot topic that it is affected slightly with your taxes.
Okay, and by repealing the individual mandate, what that really does do is it paves the way for changes coming forward, which allows people to go off the exchange and buy a different form of insurance. If it's better and it meets their needs, they're no longer going to be penalized for doing that. So that's basically why it was put in place here. It's just paving the way going forward. Tyler, I think we hit a lot of tax information. Again, I told our listeners we are not CPAs. However, any of these items that we talked about today, if you have any questions, feel free to give our office a call. Come on in. We can meet with you, talk about tax implications. We'll also get you in front of our tax advisors or a CPA so you can ask those specific questions. Taxes are extremely important in the retirement process. They can hinder or they can help your situation. It's very important to sit down with a financial advisor, go through your withdrawals, go through the investments that you have prepared, your retirement income plans, and stage the taxes. Look forward, find out what your tax implications are going to be. I think that's all the time we have this week, folks. Hope you enjoyed the show, and we'll see you again next week.
Thanks, Dean. We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.